In the previous section, we explored how leases function as both a conveyance and a binding contract, establishing the rights and responsibilities between landlord and tenant. Now, we will examine the different types of leases used in real estate transactions. Each lease type determines how expenses, maintenance, and profits are shared, depending on the property's use, the parties' financial goals, and the structure of the agreement. Understanding these variations allows real estate professionals to match the right lease to the right situation and to advise clients on their financial and legal implications. Gross lease. A gross lease, often called a full-service lease, is one of the simplest and most common lease structures. Under a gross lease, the landlord agrees to pay all of the property's operating expenses, such as taxes, insurance, maintenance, and repairs, while the tenant pays only rent. The tenant's rent payment therefore includes compensation for the landlord's expenses, resulting in a higher rent level than in a net lease. Gross leases are most frequently used in office, industrial, and residential properties, where tenants typically occupy smaller spaces and prefer predictable monthly costs. For example, an apartment tenant paying a fixed monthly rent that includes trash, landscaping, and property taxes is under a gross lease. Even though the landlord bears most expenses, they often recover these costs by charging slightly higher rent. Residential leases almost always take the form of a gross lease, although tenants commonly pay their own utilities. Net lease. A net lease shifts some or all operating expenses from the landlord to the tenant. In this arrangement, the tenant agrees to pay rent plus certain expenses such as property taxes, insurance, utilities, and maintenance. The landlord effectively passes through expenses, ensuring that the tenant shares the cost of ownership. Net leases are common in commercial and industrial properties, especially where tenants occupy large spaces or long-term leases. They are often divided into categories such as single net, N. The tenant pays property taxes in addition to rent. Double net, NN. The tenant pays taxes and insurance. Triple net, NNN. The tenant covers all expenses, including taxes, insurance, and maintenance. In a triple net lease, the tenant assumes nearly all property-related costs, freeing the landlord from day-to-day expenses while providing a stable, predictable income. However, tenants under NNN leases must carefully budget for fluctuating expenses, such as rising taxes or insurance premiums. While the terms gross and net may sound absolute, many leases include a mix of both characteristics. A modified gross lease, for instance, might have the landlord cover building maintenance while the tenant pays utilities and janitorial costs. Percentage lease. A percentage lease is unique to retail properties and allows the landlord to share in the tenant's business success. In this type of lease, the tenant pays a base rent plus a percentage of their gross sales. Percentage leases are structured in several ways. A fixed percentage of gross revenue with no minimum rent. A fixed minimum rent plus an additional percentage of gross sales. Whichever amount is greater between the minimum rent or the percentage rent. For example, a retailer leasing space in a shopping mall might pay $3,000 per month, plus 5% of all gross sales exceeding $50,000. This structure aligns the landlord's income with the tenant's success. If sales increase, both benefit. Residential lease. A residential lease may technically be a net or gross lease, but in practice, it functions almost entirely as a gross lease. The landlord typically covers property taxes, insurance, and major repairs, while the tenant pays rent and utilities. Because residential leases are short-term, often 1 year or less, landlords assume responsibility for major expenses and recoup them through higher rents. Residential leases also tend to be standardized for compliance with state landlord-tenant laws. Most apartment communities use uniform leases to ensure fairness and consistency among all tenants. The clauses in residential leases are generally non-negotiable, unlike in commercial agreements. Commercial lease. A commercial lease can take the form of a gross, net, or percentage lease, depending on the property's use and negotiation between the parties. These leases are typically long-term and complex because they involve larger financial commitments and often require tenant improvements. Key characteristics of commercial leases include longer terms, sometimes extending up to 25 years, detailed provisions for tenant improvements to customize the space for specific business needs, highly negotiable terms, since both parties aim to balance cost, flexibility, and responsibility. Serious financial implications, as defaults can result in significant losses. Because commercial tenants frequently invest in custom build-outs or expensive equipment, leases must clearly define who owns these improvements at the end of the term. Commercial leases also often contain renewal options, expansion rights, or first right of refusal clauses that align with long-term business planning. Ground lease. A ground lease, or land lease, concerns only the land portion of a property. The landlord leases the land to a tenant, who may develop, improve, or use it while paying rent to the landowner. The tenant typically owns the improvements during the lease term, but ownership of those improvements usually reverts to the landowner once the lease expires. Ground leases are used in three main circumstances: when an owner leases raw land for agriculture, mining, or energy use; when a developer builds on leased land to avoid purchasing it outright; when an owner of improved property sells the building but retains ownership of the land. These leases are inherently long-term, often spanning 30 to 50 years, to allow tenants time to recover construction costs and profits. Ground leases can provide financing, appreciation, and tax advantages for both parties. For example, a developer may lease land to build a hotel, retaining cash for construction, while the landowner benefits from rising land value without managing the property. Proprietary lease. A proprietary lease is a special type of lease used in cooperative ownerships. Instead of paying rent to a landlord, the tenant is also a shareholder in the cooperative corporation that owns the building. The proprietary lease grants the shareholder the right to occupy a specific unit. This lease does not have a fixed rent amount. Instead, the tenant pays their proportionate share of the cooperative's overall expenses, such as taxes, insurance, and maintenance. Likewise, the lease term is indefinite. It lasts as long as the shareholder owns their shares. When the shareholder sells, the proprietary lease is assigned to the new owner. Leasing of rights. In some cases, only specific property rights, not the land or building itself, are leased. These can include mineral rights, air rights, or water rights. For example, a landowner may lease mineral rights to a mining company, allowing the company to extract coal or minerals while the owner retains surface rights. Similarly, a city might lease air rights to a developer or a railroad company to construct a bridge or elevated structure over public land. These rights leases are typically detailed, specifying the exact use, duration, and limitations of the lease. Unlike traditional leases, rights leases do not convey possession, quiet enjoyment, or occupancy. They convey only the specific right being leased. Summary. There is no one-size-fits-all lease. Each type serves a distinct purpose and reflects the relationship between cost, control, and use. A gross lease simplifies costs for tenants, while a net lease transfers expenses to tenants seeking long-term stability. A percentage lease aligns landlord and tenant interests in retail environments, while residential leases emphasize uniformity and habitability. Commercial leases demand precision and flexibility. Ground leases separate land ownership from improvements, and proprietary leases link occupancy to corporate ownership. Real estate professionals must understand these variations to guide clients toward leases that best match their financial and operational needs. Discussion. Why do commercial leases typically run longer than residential leases? Because commercial tenants invest heavily in build-outs and need long-term stability to recoup their investment and operate profitably. How does a ground lease benefit both the tenant and the landlord? It allows the tenant to develop property without buying land and allows the landlord to benefit from appreciation without managing the improvements. Why might a tenant prefer a gross lease over a net lease? Because it provides predictable monthly costs with fewer financial variables, especially for smaller tenants or short-term leases. What makes a proprietary lease unique compared to other leases? It is tied to cooperative ownership. Tenants are shareholders, and their rent equals their share of the cooperative's total expenses. Closing remarks. Every lease represents a unique balance of rights and responsibilities. By understanding how expenses, maintenance, and risk are allocated among gross, net, and percentage structures, and by recognizing specialized forms like ground and proprietary leases, agents and brokers can help clients make sound decisions that align with their financial goals. A well-structured lease not only supports property use, but also builds lasting relationships between landlords and tenants based on clarity, fairness, and mutual benefit.